talking about risk, and let's talk about how to predict and start reversal following. Now, I'm going to be honest with you. I've been teaching for a lot of years, a lot of class, a lot of students in the door. There is no way I can teach you an entire trading strategy. There's no way I can even teach you to trade. I can only give you some knowledge and some pointers because we're only going to be talking for a short while. And trading is about experience. It's about adapting things to fit you. All I'm trying to do is give you the highlights so that you have something to think about. So when you go back to look at your chart, you might be able to see something developing that we talked about tonight and then fit it into your trading. Because trading is not always easy. Trading doesn't go as smoothly for the retail crowd as it does for professional traders. And one of the biggest reasons professional traders are trading huge accounts with huge money, and they don't have to worry about the leverage and the few pennies lost. Yeah, a guy trading for a bank that's trading $10 million worth of gold. If gold goes down a couple pennies and he's out of pocket, the account's out of pocket, $100,000. He can let it ride. We don't have that opportunity. Now, most retail traders fail in Forex and CFD trading, with estimates putting the numbers to successful traders only in the 2 to 5% range. Yeah, and that's true. It means ultimately 95% of people lose their money, leave the markets. And why does this happen? Because they don't employ the proper risk management tools. This is somebody told me many, many years ago. Trading is a game. We're not talking about a gamble. We're not talking about a casino. We're talking about it's a game. When you're looking at making a trade, when you're looking at analyzing markets, you're sitting on the sidelines. Okay? You're watching that Sunday football game from the bleachers. When you go to open a trade, when you've done all of that, you rooted for the home team, you decided what they're going to do, you're yelling for that kicker to kick the field goal, do an onside kick, whatever you think he should do. At some point, you have to jump in that game. When you get in that game, when you move off the sidelines, guess what you just did? You took on mega risk. So you move from the safety of the sidelines to now you went on the field where there are all those tacklers and those ends are rushing at you, 300 pounds, coming straight at you. You've taken on risk. The time you take that risk on, it's more and more and more risk until you exit the market, till you close your trade. And no matter what happened in between, you made 5 yards, you fell back 3, you got tackled, whatever happened, it only matters at the end of that play. So having a proper exit strategy is very, very important because you have to be able to exit with profit. In the middle of that game, while you're playing that game, you have to have the right risk management so that if those rushers get past your protection and come after you, you can get out of the market, or how to go around them, or where to pass that ball to down there, or you're a kicker, that it's time to kick that ball. You have to think about that. Sidelines, risk, exit. Only time you can book profit is at the exit. Now, the market or price has 3 defined strategies, 3 defined stages, not strategies. Now, if you believe, as I do, that the markets on the whole are pretty random, and price moves like this, price doesn't move in any type of fashion. It's millions of people all over the world making millions of decisions. And most of the time even if it's going up, it's a mess. But most of the time it's moving in congestion and sideways. But there are certain times that price takes on what I call non-random behavior. And this non-random behavior is known as a trend. Price starts pushing up and make higher highs and then eases back down to make a lower high, then pushes back up to a higher high, move down to a lower high, back to higher high. During these times of non-random behavior, you can apply a lot of things to your trading decisions. But you also have to understand what stage of the market this is occurring in. So let's discuss these 4 stages. Okay. So understanding the stages that a market goes through is crucial when trading the financial markets. This cycle is unique and each stage has its own driving factor. The 4 phases of the cycle are accumulation, markup, distribution, and markdown. This isn't stuff I made up. This is stuff they even teach you in university. Okay. So the first thing we go through is accumulation stage. Now, if the markets go through this stage, remember I said a non-random market goes push, ease, push, ease, push, ease. At some point, there's these traders. They start accumulating an asset. During this accumulation phase, that asset will start to rise. So with the first stage, there's a process of accumulation. The accumulation stage is driven by larger institutional demand. Not you and me, we're buying a couple contracts of gold, we're buying a couple contracts of the euro, we're buying a couple shares of Google. No, it's the institutional buyers that start the accumulation stage. This just started. The result of this phase is the buyers slowly gaining traction in the markets, eventually pushing the market price up. This phase is where the bulls build up their authority. Now, we could also mirror this in the exact opposite if the markets were falling, but we'll talk about that as we go farther. Price action is relatively flat, creating a ranging market structure within a zone of support and resistance. Within this structure, higher lows give price action signals that the market is starting to enter this stage. So this is the basis of this accumulation stage. And when they're in this accumulation stage, these big industrials are accumulating their ownership. And they're the ones who are going to start this push and ease. Because when we realize and the rest of the markets realize they start to accumulate an asset, that's when people start joining the march, the band. So we then move from there to what's called the markup phase. The markup phase is the second phase within a trading cycle is the markup. Now, this is where personally I much prefer trading. Okay. Now, this is not a reversal trade setup. Just remember tonight, we're only here to talk about a reversal setup. Okay. That's it. But we have to get to the phase of the market where you're ready for that reversal trade. This is an area in which you would be accumulating trades. Okay. So this is where the buyers take over the gain and gain the traction. They tend to gain in the first phase. Prices push through the upper resistance levels of a trading range. Candles start to close with strong bullish bodies, sending a signal that the price is entering a second stage. In this stage, this is where an emerging bullish trend is in price. Now, for you guys have attended my other webinars before, I like to talk about locomotives. Well, imagine the accumulation phase is the locomotive sitting outside the station. They're shoveling all that coal and everything into the engine, the water's starting to boil, the steam's starting to go, and it's slowly starting to chug, 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 chug. And then in the markup phase, we start hearing the chug, 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 like an old cowboy western movie, chug, chug, but it hasn't reached that phase where it is just flying along the track yet. We can hear that increased pace. So this is the markup phase. Then we go into the distribution phase. The distribution phase is the third step, and it involves the distribution process where the sellers are attempting to take back their position in the market. Like the accumulation phase, price action on the chart is kind of flat or it eases back down. What's happened is a lot of those buyers who came in early, came in that accumulation stage, said, I've made my profit. I'm getting out of the markets. Not because anything's going to happen. I made my profit. I'm on the sidelines. I'm closing those positions. And what happens is the price on the charts will ease down or move into some sideways action before it's going to move back up. But price is building up for a drop to become cheaper. And this is what we call push ease. So we had the accumulation, then we had the push, now we have the ease. Price is starting to become cheaper. So this is signaled by a failed break of the upper level of the market structure. Price consolidates and creates lower highs, indicating there will be a sell-off taking effect. Somewhere in here, not the market's going to reverse, but these people are taking profit. So a lot of the traders, like you and me, have moved to the sideline only because we say the price got too high. We're not ready. We're not going to buy at that price. So we enter the distribution phase, which is here. Now, what we're looking at here is an expand for us because we're trading in very short-term time frames and we're looking at very close charts. What we're looking at is, in essence, this is here. This is here. This is the breakdown of what is here. Then we're going into what we would call, in a short-term time frame, a retracement. Okay, but this is the markdown phase. I just want to clean up my screen here a second. Okay, now the markdown phase is critically important because this is where we would consider putting in our reversal trade setup. So the last and final stage of the market cycle is labeled as the markdown phase. This process occurs after the distribution at a higher price. The sell-off drags price and the market begins a downtrend. Okay. Now, when you're looking at a market and it's doing, like you see in the red over here, push ease, when you expand that out farther, you see more details. You only see these details when you've expanded it out. This process provides an indication that the bears have taken over the market and have gained enough power to take price within the market to a cheaper level in the bearish direction. In other words, price moved up. The institutional buyers took their profit. The retail traders and all the other people involved are sitting on the sideline because they're saying this price is too high. And as all of these institutional sell-off, price starts to ease down. Okay, as price eases down, okay, this is when it's moving down, it's moving bearish. The bears are trying to push the price down. The bulls aren't buying, so they're not pushing the price up. At some point, now this could go this way, okay, if the bears were to win. But at some point, not the institutional buyers, but guys like you and me say, oh, this price is cheap enough, we're going to enter the market, and they're going to take the market this way. Or they don't come back in and the market goes that way. So there is a confirmation of when the price action shows a break to the lower level of the flat ranging market. Technicals show large candlesticks out of a descending horizontal distribution channel on the chart. This is the entire market cycle takes place. The whole thing starts over again and again and again and again. Push, ease, push, ease, push, ease. Reverses down, goes down, comes back, push, ease, push, ease, push, ease. Okay. Now, Jay just asked me, are the market phases reliable in all time frames or only on 1 hour and 15 and higher? No. The market phases happen just like waves or cycles, no matter what time chart you're looking at. But you're not going to make a trade based on more than a 1 hour time frame, because more than a 1 hour, even a 1 hour, is giving you an environmental outlook of price. It's not helping you except giving you some general information on making a trade, because we're trading in shorter term time frame. If you're looking to be an investor or a longer term swing trader, yes, but you should always be adjusting your charts and your time frames based on the type of trade you're making. And in our case, all of our cases, we're making short-term trades. Okay. I look at an hour. I may even look at a daily chart to give me an overall environmental, because I would like to know whether the overall controlling factor is pushing an asset up or pushing an asset down. Because when you look at a shorter time frame, you may see that it's rising upward. But the only ones that are relevant to us are 1 hour, 30 minutes, 15 minutes, 5 minutes, because we're making short-term trades. But the 4 phases of the market hold out in whatever time frame you're looking at. Now, there are different setups depending on the price action and understanding what market phases we are in. Today, we are only looking at the reversal trade setup. So trading reversals is a popular trading style. Traders tend to wish for picking the exact bottom or top or catching a strong reversal. Please, 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 please don't do that. Sometimes we call it trying to catch a falling knife. You're never going to get the very bottom. You're never going to get the very top. And you're always going to jump in too early or too late. Stop worrying about what you didn't make and only worry about what you did make. And when you analyze your trade, only analyze it not on how much profit you made, is did the trade do what you thought it was going to do? Did you protect yourself? Did you put your stop loss in the right place? And was your target point correct? I never care, did I make $1,000 or did I make $500? I only care that everything I used to set up my trade was correct. If everything I used to set up my trade was correct, then I did 100% well. And again, stop loss and risk management is so critically important. Understanding how you're going to exit the market, when you're going to exit the market, what strategy are you going to sell half of your asset, move your stop loss up closer, let it ride? Are you going to just exit the market? Are you how and where are you going to set your stop loss? These are the important parts. So one of the issues as reversals are not that common. Another challenge is that trading reversals requires more precision than trading with trend setups. So in other words, remember when I said I'd like to trade in the markup phase? That's a beautiful trend setup. A lot easier. But you have to have many different setups if you want to trade, because you want to wait for the perfect opportunity that offers you a high probability trade that fits all of your rules. So when people hear that you trade reversals, they immediately believe that you are trying to predict a change in the direction or follow the catching a falling knife trading approach, which isn't what you want to do. It's important to understand that reversal trading is not a trading style that predicts whether markets are going to turn and try to trade the absolute high or low, but that reversal trading can and should be sometimes something very different. The best reversal traders don't predict, but what they wait for is clear signs that the market has already turned. Reversal trading traders then move away from predicting and move to price following, or for like I like to call it, reversal following. Now, again, if you attended some of my other webinars and my locomotive strategies, okay, I like to explain this as the locomotive took off from wherever it was starting out the day, and the guys were shoveling the coal and the wood into the steam engine, and the engine's starting to chug, 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 and it's gaining momentum. Okay. They know there's a bend farther up, they're going to ease back down, and it eases back down. Then they're going to turn up the speed and shake. But the fact is, this locomotive is traveling very, very fast. I'm not going to tell you I'm right. It just sticks in my back of my head that somebody told me once a locomotive or a train traveling at 60 miles an hour needs 8 miles to stop. Stop correctly. They slam on the brakes, it's going to fall off the tracks. You just can't stop a moving vehicle that's moving that speed that quickly. Look, we all drive cars. We know how long it takes us to slam on that brakes on the highway to get our car to a dead stop. Okay. Our heart racing, when that, there's an accident a couple of miles up and the cars are all backed up and you see all those red lights coming on and you don't notice the last thing, you slam on that and we're all here. But when the energy is in the market pushing it up, this is the markup phase. This is the phase I like to trade. Okay. When the energies come out, this is the reversal. Okay. We don't want to predict what's going to happen. Okay. What we want to do is we want to wait till it's happened. That's the important part. Then we're following price. Okay. If the locomotive slammed on its brakes and is losing its energy, we're going to follow price. We don't want to jump in here. We don't want to jump in here. We want to get in here and get out before it goes that way. We want to follow that reversal. Yeah, we're not going to get rich that overnight, but we're going to get safe, high probability trades in. And that's what it's all about. So trading and building an edge is all about stacking the odds in your favor. However, it's important to focus on what's important and to avoid what is called paralysis by analysis, which exists when you add so many tools and indicators, rules, and price filters to your method. Okay. That makes a trading decision become too complex. Again, I emphasize risk management and exit strategy. Okay. When you're going to move off that sideline and enter the market, should be an easy decision. Okay. Because you've had the time to research, you had the time to look at it. You're jumping in, but you're jumping into risk. Okay. Now, once you're in that risk, it is how you're going to get out of it. But being so overcome by indicators, oscillators, and rules and everything, you're never going to get off that sideline and jump in that play. Okay. You need to get off the bench and get in there. But you need to get in there because you're taking on risk at that point. So you need to get in there smartly, but you need to be able to get out. And so you therefore need to know what you're going to do that entire time that ball snapped to you until the play is over. So when it comes to your trading methodology, ask yourself what you want to achieve and what the premise of your system is, and then pick the tools accordingly. If you are a trend follower, you want to look for high momentum movements. I'm a trend follower. Preferably a break of support or resistance with a lot of room and the support for the higher time frame direction or the fundamentals. If you are a reversal trader, you look for fading momentum. This is one of your biggest clues. You want to look for momentum to start easing. Now, you can use all kinds of indicators and oscillators. I use my eyeballs. I can judge and I can look at the candles and I can see when that momentum's starting to fade. I'm starting to see more wicks on the other end of the candle. I'm starting to see smaller candles. I'm starting to see closes less low. I'm starting to see less new highs in the market. I can see it, but you can use oscillators and indicators to let you know when the momentum is coming out of the market. Okay. You can look at support and resistance areas, and you can see when price kind of can't break through them. You can start to see the shift between the bulls and the bears. So the following three pillars describe what you are looking for in a reversal trade. Trading and building an edge is all about stacking the odds in your favor. However, it's important to focus and not have the paralysis. So things to look for in reversal trade. When it comes to your trading methodology, ask yourself what you want to achieve, what the premise is for your system, and then pick the tools. Keep it easy. If you're a reversal trader, you're looking for fading momentum support and resistance areas that can't be broken, and price confirmation of shifting power between the bulls and the bears. And one last little secret number factor in there is a change in volume. Some of the important reversal price patterns you're looking for is maybe if you follow and trade from candlestick patterns, not just candlestick pattern, you might be looking for a 3 inside up, or you might be looking for a pin bar. You might be looking for a mother bar and a baby bar, or you could be looking for 3 black crows or engulfing candles. It's not so much about the patterns themselves, but what the path of price tells you about the underlying dynamics. So we can see here, we got the 3 inside up pattern right here. Price failed to break here, the support line twice. And we had RSI climbing. We saw RSI break below the 40 minutes mark, was oversold, and it's moved back up. Okay, and it's diverging from price. Fading momentum is important, whereas many reversal traders just try to trade off previous support and resistance, which is kind of trying to predict. Waiting for confirmed fading momentum can make a huge difference. The RSI and stochastics indicator are good choices when it comes to analyzing momentum divergences, and the screenshot that we just looked at shows you the reversal trade with a clear RSI divergence. See, RSI is moving up, price is moving down. That gives you the divergence. The fading momentum. Okay. Price has been easing down, and you can see the momentum carrying it. You could almost also measure the speed. And then all of a sudden, we got this fading momentum in here. We lost its drive. Okay. Here, we might have said this is a reversal, a retracement, and waited for it to come down, but it didn't. Then it did finally, after it went through this accumulation here, did come back down, but it couldn't break that support level. And then what did it do? It turned and moved on to the climb or the accumulation phase. Now, we would have been looking to trade that reversal because this is where the reversal occurs. So the last main pillar of the reversal strategy is to find reversals that happen at a logical price area. Most traders make the mistake that they just look for divergence on their indicators and then hope that the trade will work out, while price trades somewhere in the middle of nowhere. Taking reversal trades that just happen at the right price is key. For that, you should start looking for false breaks of support and resistance levels or previous highs and lows. Fibonacci's are another go-to tool. Here, look for the completed Fibonacci sequence, both the last 2 reversal trades. Let me take you over that chart. Okay, so we can actually see all of this happening in the chart. We can see its fading momentum, we can see the accumulation phase, we can see the shift in momentum, and we can see the reversal trade. But as it went through this range, we could see or use our Fibonacci levels to help us to actually predict what is happening. And if price isn't able to break through those levels in one direction or the other. So what we want to do is we want to look for price areas on our charts. See where here price is rounding off. If we got the Fibonacci level, it hit the fib level and bounced off, couldn't break through it, as well as we also got a rounding off of price. If all these things come together, you often get a very precise signal of an imminent market reversal. Furthermore, by the time you see all 3 things happening on charts, price will already have turned into the opposite direction, and reversal predicting would have actually become reversal anticipating. Most traders who claim to be reversal traders are just trying to call tops and bottoms and predict market turns well in advance. Successful reversal traders enter way after the top or the bottom is formed. They don't try to predict, they wait for something in their chart to tell them. To trade reversal profitably, you must be okay with watching your setup unfold while you're standing on the sidelines, sitting up in those bleachers, and waiting for that perfect moment to jump into that play. So step one, determine if the market condition is favorable for the reversal trade strategy. Now, as Jay asked, this would happen in maybe longer term charts. We want to understand what the overall market conditions are. Well, think about this. This is a trend reversal trade strategy, right? This means we must wait until the end of the trend before entering a trend reversal. We won't be able to get into the high probability reversal movement until then. Now, what happens if we execute trades whenever the rules of the engagement of this strategy were met without considering market conditions or location? We'll end up executing trades in trends and consolidations. We'll end up executing that trade in a retracement that doesn't become a reversal. And we'll get in too late in that retracement, the markets will move back up and you would have been wrong and lost your money. So this is why trade location is important. What would be the ideal market condition or the location reversal trade? To understand that, first you must understand the 4 market cycles and have a look at the charts. You must see what phase we are in. So according to the chart, you can see that the market cycles go through 4 main stages. Remember, we discussed this earlier: accumulation, markup, distribution, and markdown. Okay. We don't want to go into a reversal trade setup in accumulation. We don't want to go into markup. So when do we want to get into it? The markdown stage. Step 2, we want to identify the weakness in the current trend. Previously, we have identified higher probability areas for possible market reversals. Now it's time to identify if there is a possibility for a market reversal in the same area. In this step, we are going to identify the weakness in the current trend so that we can prevent from getting caught in a retracement. So how are we going to do that? This is where the 2-hour time frame and an RSI divergence comes into play. But keep in mind that this is the first step process. Therefore, first we need to identify the 4-hour overbought and oversold. Then at the same time area, we need to find if there is any RSI divergence that happens in the 2-hour time frame while we're dropping back down to our 1 and our ½ hour. So to understand this clearly, have a look at the chart. So here we see the asset in a 4-hour climb. Then when we move it to a 2-hour, we can see it more precisely. We also see the divergence and the overbought or oversold in the RSI. So now, according to the above image, we have a 4-hour chart and a 2-hour chart. So have a look at the marked areas on the 4 and the I and the 2, and we can see that RSI is overbought, indicating a higher probability trade location in that area. So far we have identified 1, higher probability areas for possible market reversals. That was step 1. Confirm the likelihood of the market reversal by identifying RSI divergence. Step 3, we're going to use momentum shifts to confirm the trend reversal. Momentum shift is when the price shows strong opposite momentum against the current trend. When this happens, we call it a momentum shift. For example, assume that we are in a strong uptrend and price price rapidly starts to move against the trend, indicating strong bearish volatility. When a scenario like that occurs, we can say, okay, this uptrend is losing its momentum. Therefore, we can expect a bearish reversal. Only expect. Don't predict. Wait for it to happen. That is it. So, but there's one condition. That is, price action should respect the 50-period SMA. To find that you may need to switch between 2-hour and 1-hour time frames. For example, if the price action respects the 50 time frame SMA on the 2-hour time frame, then no need to switch down to 1 hour. If not, you must switch down to the 1 hour time frame. Now, the lowest time frame we are switching to is the 1 hour. Don't go below that for looking at your conditions. To understand this, have a look at the charts right here. So here we had the 4 hour, then we went down to 2 hour. Here we look at the 1 hour chart, because what we're getting now is we're getting a decision, not deciding what price we want to enter the market. We're getting a decision that we want to get off that bench, but what point are we going to jump in? Okay. So now we've decided we want to get off that bench, and we have to come up with the point in which we want to enter the market. So let's break down the chart. We have learned how to identify higher probability trade locations. Then we have learned how to find the weakness in the ongoing uptrend. Then finally, in this step, we have learned about momentum shifts, which help us to confirm the market reversal. So how do we capture the market reversal at the right time? Somebody just asked me, could I comment and show the stages on the 1 hour Euro US dollar chart? No, because I just can't. Okay. I'm sorry. It gets too much using current charts and doing that to a problem with the regulators and giving you trading advice. Okay. So in this step, we're talking about trade entries, stop loss, and take profits. When talking about trade entries, we need an entry method with a high probability and a maximum profit potential. How are we going to achieve this? Well, now that we have a reversal patterns, how are we going to use it? We might look for triple tops and triple bottoms, head and shoulders patterns, a break of a local structure, or MACD. But how do we determine how we're going to put our stop loss, our take profit, and our entry point? So we went from step 1, the 4 hour time frame, to the overbought. We went to step 2, the RSI divergence. Step 3 is the price action respecting the moving average. Therefore, we're waiting for a bearish breakout of the moving average to confirm the momentum shift that we got as well. So simple. After identifying the reversing chart pattern, in this case, it's the momentum dive pattern, we just have to place a sell stop a few pips below the mark zone. Observe the above 1 hour chart, and we can see that we place our entry a few pips below the market zone. So we can see it here on the chart. The green is where we put our target point, our stop loss, because we're selling in this market, and this is our entry point. Okay, so we've got everything we wanted. With the break of the 50-period moving average, we have our divergence. We've now decided we have a reversal trade setup. We've gone into the sideways action, and we're looking for a price to enter. And when we get the confirmation the market is shifted, it's not going into a retracement, we would then enter the market. So again, it's simple. We must calculate the distance of the mark zone and place the stop loss twice the difference. For example, if the distance of the zone is 15 pips, then your stop loss should be at 30 pips. If you look at the above chart, you'll notice that we did the same thing, but placed the stop loss twice as big as the zone area. After we completed all 4 steps we've discussed thus far, we can move on to grading our trade setup. This step is all about grading our trade setup, and for that, we just need to find out whether there's another trading confluence aligned with our reversal trade setup. If there are more confluences, then we can mark the trade setup as a higher probability trade setup. The only difference with these 2 trade setups is that we will have a higher probability trade setup. Only trade with the high probability setups. So again, as I told you before, I've given you food for thought. Okay. Use this in your thought process and start using these ideas to see what the market is doing, what price is trying to tell you, and then try to mold them into your own so that you fully understand them. And on that note, I'm going to say good night. Thank you very much, and I hope you learned a little bit from me tonight. Good night now.